This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, I'm Lee Adler, and this is Radio Free Wall Street for Thursday, April 23rd, 2015. Well, in looking at the economic data and the market action, as always, I ask myself the question, has anything changed? Are the trends that have been in force in any way looking any different? Those are the key issues, because if we just look at the headlines, as the economic data is released and all the geopolitical stuff that's going on, you would think the market would be headed down, or we'd be getting whipsawed every other day. One report is negative, the next one is positive, and the numbers really don't make a lot of sense if we just look at the headline data. That, of course, is the seasonally adjusted nonsense that then gets annualized, and therefore the error is multiplied times 12. Sometimes it reflects the trend accurately, but it is an inaccurate representation often enough so that it can mislead, and often does mislead, the market. But after a period of time, whether it's minutes or hours, the market gets back on track and it goes back to trending slightly higher, as it has been for some time now. We inched out to a new high today on an intraday basis, closed on the S&P about 2 points below the closing high, got to within a few points of cycle projections, which are in the 2130 area now for the shorter term projections, and a little bit higher than that looking out to a 13-week cycle, which is pointing to around 2160. And in truth, not much has changed in terms of the real driver of the market, the excess liquidity. That still keeps rolling in, either from the ECB or the Bank of Japan. The Fed, of course, has stepped aside. It's not creating any more excess liquidity. It's not growing its balance sheet, and it's not creating any new total liquidity, but it is still pumping cash into primary dealer trading accounts at the middle of every month when it settles its MBS purchases. And that period ended just today, and the Fed pumped in about $28 billion, $29 billion in cash into these dealer accounts, so it had to go somewhere. At the same time this week, we had a tidal wave of tax receipts. One of the things that does look just slightly different is the daily reports on withholding taxes. I'll show you a chart of that in a little bit. That's been kind of holding steady at a growth rate of about 5% annually on a nominal basis, and adjusted for inflation, maybe around 3%, which still is indicative of GDP growth of probably 2.5% to 3%, a lot higher than the market is currently expecting. But in the last few weeks, instead of cycling as the taxes are collected, as they have been during the year, they've tended to kind of rise and fall every 3 to 4 months. They've remained relatively flat lately at about a 5% growth rate. So that's a little different. So we got to keep an eye on that to see what that might mean and how that might change going forward in the weeks ahead. Are we going to get a blow-off in the economy, or are we going to begin to contract? So I think that's where our early warning is going to come. We're going to take a look at that. The big issue, I think, is these massive individual income tax collections that have come in so far here in April. We have data through April 21st now, and the numbers are just off the chart. Individual income taxes for the first 21 days of April on a calendar basis, and 5 days of collections since the due date, are now running a whopping 47% higher